Last December, there was this company, and honestly, you have probably never thought twice about them, but they processed $9 trillion.
Yeah, which is just a staggering number to even wrap your head around.
Right. And we are not talking about over a decade or, even over a year. They did that in one single month.
Just massive, massive volume.
That is $384 billion every single day. And it's moving through this completely parallel blockchain-based financial network that this company secretly built.
Built completely under the radar, too.
Exactly. And here is the absolute kicker for you listening. This is the exact same, boring administrative company that literally sends you those dry, physically printed proxy voting packets in the mail whenever you buy a stock.
The ones that immediately go into the recycling bin.
Yep. Those exact ones. So today, welcome to a special Talk Tickers edition of the Deep Dive. We are breaking down the Q2 2026 earnings transcript of Broadridge Financial Solutions, ticker symbol BR.
It's the ultimate paradox in modern finance right now.
It really is.
You have this legacy business, right, built entirely on physical mailings and regulatory disclosures, but they are quietly transforming into the architect of the whole decentralized financial future.
Which sounds crazy for a mailing company.
I mean, we are looking at an infrastructure company that is just playing a completely different game than the rest of Wall Street right now.
And that is exactly our mission for this deep dive because, we are going to cut straight through all that dense corporate jargon from the earnings call. We're going to look at the hard data, translate the actual mechanics of what's driving these results, and give you a clear, actionable bottom line.
Absolutely.
Like, is this stock actually a strong signal for your portfolio? So let's just get right into the headline numbers because the surface level metrics here, they tell a very, very deceptive story.
Oh, highly deceptive. You really have to dig in.
Yeah, so Broadridge reported that their recurring revenue in their governance segment grew 8% on a constant currency basis. So they hit $590 million for the quarter.
Which honestly is a remarkably sturdy foundation. I mean, they grew 8% on a constant currency basis.
Right.
Meaning, even if we strip out all the noise of the strong US dollar and we just look at pure operational business performance on a global scale, they are compounding their revenue rapidly.
Which is hard to do with their size.
Exactly. For a company with a monopoly this deeply entrenched, grinding out an 8% organic growth rate is incredibly difficult. It requires just massive, massive scale.
Okay, right. But then I look at their bottom line, the adjusted earnings per share, their EPS.
Yeah.
It came in at $1.59, which, if you do the math, that is only a 2% growth year over year.
I know, it jumps right off the page.
Right, because in a booming market, U.S. equities rose 16% in the calendar year. So a 2% EPS growth sounds like a severely leaky pipe.
It does. It sounds awful.
If I'm holding this stock, a 2% bottom line growth is dangerously close to stagnation.
Yeah.
So I got to ask, what is dragging that down? Is that a massive miss?
It looks like a massive red flag until you dig into how corporate finance teams actually classify their revenue streams.
Okay, unpack that for me.
So Broadridge has a core predictable business, right? But they also have this highly volatile segment that they call event-driven revenues.
Wow.
And to really understand that 2% number, we have to look at the mechanics of what an event actually is in this specific context.
Wait, because event-driven revenues sounds like a very polite Wall Street way of just saying, unpredictable chaos.
That's a pretty good way to describe it, actually.
Like, what actually triggers this cash for them? Are we talking about server outages or a market crash or something?
Far from it, actually. We are talking about corporate drama.
Drama.
Yeah, an event is typically a massive, unpredicted corporate action. So imagine two Fortune 500 companies, and they're locked in this huge, hostile merger and acquisition contest.
Oh, like a real boardroom battle.
Exactly. Or imagine an activist hedge fund, and they are aggressively trying to take over the board of directors at a major mutual fund.
Okay, I can picture that.
Well, when that happens, the company under attack is legally required to communicate with every single one of its shareholders multiple times.
Oh, wow. I didn't even think about the logistics of that.
Right. They have to send out millions of emergency mailings, digital notifications, legal disclosures, and then they have to instantly tabulate the real-time voting results from millions of retail and institutional accounts.
And since Broadridge effectively owns the plumbing for all that shareholder communication.
They are the ones who get the panicked phone call.
Right. They get the call to execute all of that logistics.
Exactly. So they basically get to charge a massive premium for facilitating the proxy war. They print the ballots, they route the digital votes, they secure all the data.
Man, what a business model.
It really is. And last year, during this exact same second quarter, Broadridge experienced an absolute freak wave of this event-driven activity.
Like a spike in drama.
Yeah, it was a record-breaking quarter for corporate proxy fights and special mutual fund meetings. So they made a highly unusual, massive windfall of cash last year.
Okay, I see where this is going.
Right. So when Wall Street algorithms look at this year's EPS of $1.59, they are comparing it to last year's anomaly.
Ah, so they are lapping a remarkably high comparison.
Precisely.
It's like judging a retail store's random Tuesday sales against last year's Black Friday performance.
That is the perfect analogy.
So the 2% growth isn't because the core business is slowing down. It's because they're trying to beat a high score that was just artificially inflated by a bunch of random corporate fistfights last year.
That is the exact mathematical reality. In fact, Ashma Ghei, she's Broadridge's chief financial officer, she explicitly pointed out on the call that if you strip out the noise of last year's proxy fight anomaly,
the core business looks totally different.
Exactly. Their core organic revenue growth was actually a very strong 7%.
Oh, wow. Okay, that is a huge difference.
The day-to-day predictable software and governance business is operating with extreme consistency. So that 2% EPS growth you saw, it is purely an optical illusion.
Okay, that completely changes the context of the bottom line for me. Especially when you look at their closed sales, which, that's a metric I always hunt for in B2B software companies.
It's the most important metric for future growth.
Totally. And closed sales jumped 24% to hit $57 million for the quarter.
A huge jump.
Right, because in enterprise software, closed sales are the lifeblood. I mean, that is the raw pipeline of signed contracts that they haven't generated cash yet, but they absolutely guarantee future recurring revenue.
Exactly. It's locked in future money.
So a 24% jump means banks are just aggressively ripping out their old systems and locking into long-term Broadridge contracts right now.
It is the ultimate leading indicator of future health.
Yeah.
But there is another number in this transcript, and honestly, it completely eclipses the closed sales. It fundamentally changes the identity of Broadridge as a company.
Oh, I know exactly what number you're talking about.
Yeah. Tucked into the accounting was a $187 million non-cash mark-to-market gain on digital asset holdings.
$187 million from crypto.
Yep.
On the balance sheet of the most boring administrative company on Wall Street.
I know. It's wild.
I mean, this is the part of the transcript that literally forced me to read it 3 times. Let's really break down the mechanics here, because non-cash mark-to-market gain sounds like some accountant just, manifested money out of thin air.
It does sound like financial alchemy, I'll give you that.
Yeah.
But it is actually a strict requirement of fair value accounting under current financial regulations.
Okay, so how does that work in plain English?
So mark-to-market means that at the end of every single quarter, a company has to look at the assets it holds on its balance sheet. And they have to adjust their recorded value to match whatever the current open market price is on that exact day.
Got it. And in this specific case?
In this specific case, Broadridge holds a massive treasury of cryptocurrency, specifically Canton Coin.
Canton Coin, right. Which is the native digital token of the Canton blockchain network, which Broadridge is actually a founding partner of.
Correct.
And the transcript notes that the value of Canton Coin just skyrocketed. It went from 4 cents at the end of September up to 15 cents by December 31st.
Right. And because Broadridge holds hundreds of millions of these tokens, that sudden price jump from 4 cents to 15 cents, it mathematically increased the total value of their balance sheet by $187 million.
Just off the price jump alone.
Exactly. And it is labeled non-cash because Broadridge didn't actually sell those coins on a crypto exchange to realize the profit.
The money isn't sitting in their checking account.
Right. It is purely paper wealth based on the snapshot price on the very last day of the quarter.
And what I found so fascinating about this is how Ashma Ghei, the CFO, handled this windfall.
She handled it perfectly.
She really did. Because if I am a corporate executive and my APS just optically shrank to a 2% growth, the temptation to use a massive crypto gain to artificially juice my earnings report has to be just overwhelming.
Oh, absolutely. Most executives would be tempted.
But they completely stripped it out.
They did. And it is a masterclass in conservative, shareholder-friendly corporate governance.
Yeah.
Gay was incredibly explicit on the call that they intentionally excluded this entire $187 million gain from their adjusted EPS calculations.
Which is so smart because crypto is so volatile.
That is the exact structural reason. Digital assets are notoriously volatile. If Canton Coin drops back down to 5 cents next quarter, mark-to-market accounting would force Broadridge to report a catastrophic $100 million loss.
Which would terrify Wall Street.
Exactly. So by excluding these wild non-cash swings in paper money from their adjusted metrics, they are giving you, the investor, the unvarnished truth about how their actual software and processing and mailing businesses are performing.
But it's not like they are just letting these coins sit in a digital vault, gathering virtual dust, right?
Not at all.
Because the transcript shows they took 342 million of those Canton coins, which were valued at roughly $53 million at the time, and they used them as literal currency to buy an 8% ownership stake in the Terramine digital asset treasury.
Yep, they put it to work.
So they are actively leveraging this paper wealth to buy permanent equity in the broader blockchain ecosystem.
Which is a brilliant transition into the actual core narrative of this quarter. Because if the legacy business is steady and they're sitting on this appreciating treasury of digital assets, we have to look at what they're actually building with all this capital.
Right.
Because CEO Tim Goeke sounded remarkably aggressive on this earnings call. I mean, he is pushing his chips to the center of the table on tokenization.
Yes, and this is where we really have to dive into the mechanics of the distributed ledger repo, the DLR platform.
This is the real game changer.
I mentioned in the intro that they tokenized $384 billion a day. But to understand why that is such a revolution, we kind of have to understand how broken the traditional repo market actually is.
It's incredibly broken.
So when I think about a repurchase agreement, a repo, I picture a massive high finance pawn shop.
That's a great way to look at it.
A mega bank, let's say JPMorgan, they need $1 billion in cash overnight to meet some regulatory reserve requirement.
Right.
So they go to another institution and they hand over $1 billion in U.S. Treasury bonds as collateral to borrow that cash. And then the next morning, they buy the bonds back, paying a tiny fraction of interest.
That's the basic mechanic.
But the actual physical or, legacy digital movement of those treasury bonds across custodian banks is incredibly clunky, isn't it?
It is shockingly antiquated. I mean, in the traditional repo market, moving that collateral from one custodian bank's ledger to another involves multiple intermediaries.
Like middlemen.
Exactly. Middlemen, massive batch processing mainframes, and hours, sometimes days, of settlement delay.
Wow.
And that delay creates what we call settlement risk. If the market crashes during those few hours while the collateral is essentially in transit, well, someone is left holding the bag.
That sounds incredibly stressful for a bank.
It is. And because of this friction, banks have to over-collateralize their loans and hold all this excess capital just to buffer against the sheer inefficiency of the plumbing.
Enter the distributed ledger repo.
Exactly.
Broadridge is basically replacing that clunky pawn shop with a blockchain-based smart locker.
That is a highly accurate way to visualize it. On the DLR platform, the U.S. Treasury bond doesn't actually move anywhere.
It just sits there.
It stays locked in a secure digital smart contract. Instead, a digital token representing the ownership of that bond is created.
Okay, I'm with you.
So when JPMorgan wants to borrow cash from another bank, they execute an atomic settlement on the blockchain.
Atomic settlement, meaning the exact millisecond the digital cash moves to JPMorgan, the token representing the treasury bond moves to the lender. Like it happens simultaneously.
Instantly and simultaneously. There is zero settlement delay.
Wow.
There is zero friction. The ownership transfers permanently on a decentralized ledger. This allows these massive banks to move capital with absolute mathematical certainty.
Which means they don't have to hold as much buffer capital.
Exactly. It radically reduces the amount of excess capital they need to hold. And when you understand that mechanism, you understand why the adoption curve for DLR is just exploding.
$9 trillion in December alone.
Yeah. They have doubled their volume since June.
And it isn't just confined to overnight government repos anymore either.
No, they're expanding rapidly.
There was a massive milestone buried in this transcript. Broadridge just completed Societe Generale's first digital corporate bond issuance in the United States using this exact same DLR platform.
That is a huge proof of concept.
They are proving they can tokenize and issue highly regulated, multi-million-dollar corporate debt on a blockchain, completely circumventing traditional bond issuance mechanics.
But, this incredible technological leap brings up an existential threat for the company.
Yeah.
And it was articulated perfectly by UBS analyst Alex Cram during the Q&A portion of the earnings call. I think it is the central tension of Broadridge's entire corporate strategy.
Oh, this was easily the most important exchange in the whole transcript.
Yeah.
Because Alex essentially asked the question that every single crypto native developer has been screaming for a decade.
Right. Why do we need you?
Exactly. Isn't blockchain supposed to kill the middleman? If you build a flawless, decentralized smart contract where two banks can trade assets instantly without an intermediary, why on earth do they need Broadridge?
It's a totally fair question.
Aren't they literally writing the code that will automate themselves out of existence?
It is the ultimate innovator's dilemma. Are they building their own guillotine? But CEO Tim Goeke's response was just fascinating because it highlighted the massive blind spot of the whole techno-utopian blockchain narrative.
Regulatory compliance.
Exactly. Regulatory compliance. Goeke isn't scared of disintermediation.
Right.
He is banking heavily on the fact that decentralization actually creates a catastrophic mess for corporate issuers.
Because, sure, you can invent a frictionless smart contract, but the IRS is still going to want their tax revenue.
You can't code away the IRS.
Right. And the SEC is still going to mandate proxy voting rights.
Exactly. Let's look at the mechanics of a fully tokenized future market. Goeke laid out this scenario where a massive corporate issuer, let's say Apple or Microsoft, they won't just have one single type of stock anymore.
Okay, so what will they have?
They are going to have traditional registered shares sitting at transfer agents. They are going to have beneficial shares held in street name by traditional brokerages like a Charles Schwab.
Right.
And then they're going to have new tokenized digital shares. And those tokenized shares won't just exist on one single blockchain.
Oh, right, because there are so many of them.
Exactly. They will be fragmented across Ethereum, the Cant-Han network, Polygon, and multiple competing Layer 1 blockchains.
Man, that sounds like an absolute nightmare for a corporate compliance officer.
It's a total mess.
Imagine trying to pay a quarterly dividend in that environment. You have to send cash to a mainframe in New Jersey, wire money to a custodian in New York, and somehow airdrop digital stablecoins to millions of anonymous wallets across 4 different decentralized networks.
All at the same time.
All while perfectly calculating the capital gains tax for every single jurisdiction.
It is an unmitigated disaster for corporate governance. The regulatory, the tax, and the communication complexities, they don't disappear in Web3. They multiply exponentially.
Wow. Okay, I get it now.
So rather than being cut out, Broadridge is positioning itself to be the indispensable omni-bridge.
The omni-bridge.
Yeah. They are basically telling Wall Street, go ahead, launch 100 different competing blockchains. We don't care who wins.
Let them fight it out.
Exactly. We will build the singular infrastructure layer that tracks the tax lots, handles the class action lawsuit notifications, and processes the proxy votes across all of them simultaneously.
They're essentially future-proofing their own monopoly by just fully embracing the chaos.
Exactly.
And Goeke put a hard deadline on this too. He promised that by the end of this fiscal year, they expect to fully integrate tokenized and digital assets into their primary legacy processing engines.
That's a huge promise.
And they are also extending these solutions directly into digital wallets. So if I hold a tokenized share of a company directly in a self-custody digital wallet, Broadridge will still automatically ping my wallet with my legally mandated voting rights.
Seamlessly bridging the gap.
Right, bridging the gap between my cryptographic keys and the company's traditional boardroom.
It is the ultimate defensive mode. But, the blockchain teleporter is really only half of their technological offensive here.
Oh, right, the AI.
Yes. The other massive revelation in this transcript was their deployment of artificial intelligence, specifically targeted at the proxy voting revolution.
And this is something Goeke referred to as a quiet revolution in shareholder engagement. Because, let's be honest, for decades, proxy voting has been the most ignored, paper-heavy process in finance.
Nobody reads those booklets.
You get a thick booklet in the mail, you throw it away, and the board of directors does whatever it wants. But Broadridge is rolling out what they call a voting choice solution, and the numbers here are just staggering.
They really are.
This coming proxy season, they expect more than 600 institutional funds, which represents $4 trillion in assets, to use this new voting platform.
That is double the assets from just 12 months ago.
Double.
To understand why this adoption is just going vertical, you really have to understand the immense political and regulatory pressure that's currently squeezing the biggest asset managers in the world right now.
Oh yeah, the political heat is intense.
The transcript explicitly name-dropped JPMorgan and Wells Fargo as key clients adopting this AI. So we need to look at the mechanics of how these massive banks actually vote.
Let's break that down because it is a fascinating bottleneck. If you were JPMorgan, you manage trillions of dollars across thousands of different companies.
Thousands.
And every spring, all of those companies hold their annual shareholder meetings. There are thousands of board members to elect, thousands of executive compensation packages to approve, and thousands of environmental or governance proposals to vote on.
It's an ocean of paperwork.
It is physically impossible for human analysts at JPMorgan to read 10,300-page legal documents in a single month and make an informed vote on every single line item.
It just can't be done. So historically, what did these massive banks do? They outsourced the intellectual labor.
Right.
They relied heavily on a virtual duopoly of third-party proxy advisory firms, primarily Institutional Shareholder Services, which is known as ISS, and Glass Lewis.
The two heavyweights.
Exactly. These two advisory firms would read the proxies, create a blanket recommendation based on their own internal guidelines, and the big banks would largely just auto-vote whatever ISS or Glass Lewis told them to.
But over the last few years, that has sparked a massive political backlash. Politicians and corporate boards started asking, wait, why do two unelected advisory firms in a duopoly get to essentially dictate how trillions of dollars of American index fund money votes?
Exactly, especially on highly sensitive issues.
Right, like climate change mandates or labor union policies. The banks were taking massive heat for outsourcing their fiduciary duty.
So the banks desperately want to take back control of their voting power. JPMorgan wants to vote according to JPMorgan's specific bespoke governance philosophy, not Glass Lewis's.
But they still have the same mechanical problem. They don't have the human workforce to read 10,000 proxies.
Precisely. And this is where Broadridge's AI-native custom policy engine steps in and just completely solves the bottleneck.
I want to focus on the mechanics of this custom policy engine, because this isn't just like a chatbot summarizing an earnings call.
No.
This is applied natural language processing in a highly regulated legal environment. So how does the AI actually execute a vote?
It operates through a very complex logic mapping system. First, Broadridge ingests JPMorgan's proprietary, let's say, 50-page internal governance philosophy document.
Okay.
This document outlines exactly how JPMorgan wants to handle specific issues. For example, the document might say, we always vote against executive compensation packages if the CEO's pay has increased by more than 20% while the stock price has declined.
Got it. A concrete logic trigger.
Exactly, a hard rule. Then the AI ingests the thousands of dense legal proxy statements flooding in from companies globally.
The actual ballots.
Right. The natural language processing engine scans these hundreds of pages, identifies the exact clause outlining executive compensation, cross-references that data against the company's stock performance, maps it against JPMorgan's bespoke rule, and automatically triggers a yes or no vote. Wow.
It executes complex, nuanced fiduciary decisions at machine speed.
So it allows the mega banks to bring their voting back in-house, fully customized, entirely objective, and totally defensible to regulators, all without having to hire an army of human lawyers. Exactly. It is the perfect enterprise-grade use case for large language models.
They're literally monetizing the corporate governance debate.
They really are. And the CEO noted this AI proxy suite alone could become a multi-$100 million market for them.
And importantly, they're extending this technology down to the retail level too.
Yes, the retail side is fascinating.
The transcript highlighted a pilot program they are running with ExxonMobil. They're allowing everyday retail shareholders to provide standing voting instructions.
Which completely removes the friction of participation for the average person.
Totally. As a retail investor, I can log into the system once and tell the AI, look, I always want to vote in line with the board of directors' recommendations, or I always want to vote in favor of independent board chairman.
Set it and forget it.
Exactly. I set my philosophy once, and the Broadridge engine automatically applies my logic to every future annual meeting indefinitely. I never had to open another piece of physical mail.
It is a massive step forward for retail enfranchisement. And speaking of retail investors, this transcript provided a fantastic macroeconomic window into the health of the retail market as a whole.
Yeah, let's talk about that.
We always wonder if the everyday investor is still engaged. Broadridge tracks the actual underlying data plumbing so they see the truth. And they reported that total equity positions grew a massive 17% overall.
Let's clarify what a position means in this context, just because it is crucial for understanding Broadridge's revenue. If I open up an app and buy one single share of Apple, that is one position.
Correct.
So a 17% growth means there has been a massive explosion in the sheer volume of individual stock holdings being tracked.
Huge volume.
But the transcript also noted that their revenue-generating positions only grew by 11%.
Yeah, there's a big spread there.
There is a massive gap between the 17% total growth and the 11% revenue-generating growth. Why does a new stock position not automatically equal new revenue for Broadridge?
That gap is the direct result of the fractional share revolution.
Fractional shares.
Right. Over the last few years, brokerages have allowed retail investors to buy, $5 worth of Amazon or $2 worth of NVIDIA.
Right. I do that all the time.
Millions of young investors are building portfolios out of these tiny fractional slices. Now, from a data processing perspective, Broadridge still has to track that $5 position. They still have to legally calculate the micro dividend. They still have to route the proxy vote.
So the data drag on their servers is identical to $1 million trade.
Exactly, identical.
Yep.
But because the economic value of that $5 fractional share is so microscopic, Broadridge cannot ethically or even legally charge the brokerage their full traditional processing fee.
Oh, that makes sense. The fee would wipe out the investment.
Right. They have had to implement these tiered pricing models where they essentially process these micropositions for pennies or sometimes even at a loss just to maintain their overall contract with the brokerage.
Okay.
That is why total volume is up 17%, but the subset of accounts that actually generate meaningful revenue is only up 11%.
That makes perfect sense. The plumbing has to handle a massive surge of low pressure water, so to speak.
Great analogy.
But an 11% growth in pure profitable equity positions is still an incredibly hot number. It proves that the retail investor is aggressively in the market buying individual equities.
Furthermore, we saw a massive recovery in mutual fund position growth.
I saw that.
Yeah, in the first quarter, mutual fund positions had flatlined to a mere 2% growth. That was due to some weird timing anomalies with fund reporting.
Right.
But in the second quarter, it roared back to a 15% growth rate. So if we smooth out the noise and look at the first half of the year combined, mutual fund positions are growing at a very healthy 8%.
That's solid.
The underlying retail ecosystem, both in equities and passive funds, is remarkably robust right now.
Okay, so we have the story. The legacy business of tracking stocks and mutual funds is growing steadily. They are sitting on a massive pile of cash from elevated corporate proxy fights.
Yep.
They are taking that cash cow and aggressively funding the blockchain infrastructure that is settling trillions in repo trades. And they are deploying AI to solve the proxy bottleneck for the biggest banks on earth.
Firing on all cylinders.
Which brings us to the forward-looking aspect of our deep dive. Management guidance. What did CEO Tim Goeke and CFO Ashima Ghei officially promise Wall Street for the rest of 2026?
Well, they started by reaffirming their core baselines. They maintained their target of 5 to 7% recurring revenue growth for the full year.
Okay.
They reaffirmed they expect to hit between $290 million and $330 million in total closed sales.
Also solid.
But the metric that stands out most is their operating margin. They maintained their target of 20 to 21% adjusted operating income margins.
A 21% operating margin is phenomenal. But it is especially impressive given the context of what we just discussed.
It really is.
I mean, they are pouring tens of millions of dollars into developing the Canton blockchain network. They are building bespoke AI logic engines for JPMorgan.
That's true.
Enterprise-grade AI and blockchain development are incredibly capital-intensive.
Hugely expensive.
Yet they are not sacrificing their profitability to fund it.
That is the magic of their capital allocation. They are effectively using the high-margin legacy toll booth of their mailing and proxy business to entirely subsidize their futuristic R&D.
That's amazing.
They're funding tomorrow strictly out of their excess cash flow today.
But they didn't just maintain their baselines. They actually gave Wall Street an upgrade.
They did.
They raised their adjusted EPS growth outlook. Previously, they had modeled an 8 to 12% growth rate for the year. On this call, they bumped the floor up telling investors to expect 9 to 12% adjusted EPS growth.
And raising the floor of earnings guidance is the ultimate signaling mechanism of management confidence.
For sure.
But what makes this specific raise so fascinating is the macroeconomic environment it is happening in.
Right, because Ashmagay noted a specific revenue headwind that is terrorizing the rest of the financial sector right now. Lower interest rates.
Yeah, the Fed cut.
The Federal Reserve has been cutting rates. And if you are a financial infrastructure company that holds billions of dollars in client cash balances, falling interest rates mean you earn less yield on that float.
It's a direct hit to revenue.
So how on earth is Broadridge raising their earnings guidance while the Fed is actively cutting the interest rates that supply their float revenue?
It is a phenomenal question of corporate treasury mechanics. And Ashmagay addressed this head on.
Okay, what did she say?
She acknowledged that, yes, the falling interest rates will mathematically reduce the revenue they earn on client cash sweeps. She quantified it as a 1-point drag on their top-line revenue growth.
Okay, so it is a real hit.
It is. However, she stated that this revenue hit is functionally hedged.
Functionally hedged. Let's really dig into the mechanics of that, because that is a term corporate treasurers throw around. But the underlying balance sheet engineering here is brilliant.
It is. Let's look at the liability side of Broadridge's balance sheet. Broadridge carries a significant amount of variable rate debt, meaning the interest rate they pay to service their own corporate loans is not locked in. It floats up and down based on the broader Federal Reserve rates.
And just to clarify for everyone listening, why does a highly profitable tech company carry so much floating rate debt in the first place? Why not just lock in a fixed rate bond?
Because of how aggressively they acquire other companies. When Broadridge wants to buy a smaller tech firm for, say, $200 million, they often use commercial paper or short-term variable rate term loans to finance the acquisition quickly.
Instead of issuing a massive 30-year corporate bond.
Exactly. So they carry this floating debt on their balance sheet.
Oh, I see the mechanism. As the Federal Reserve cuts rates, the revenue Broadridge earns on their client cash balances drops. But simultaneously, the interest expense they have to pay out every month to service their own variable rate debt drops by almost the exact same mathematical amount.
You nailed it.
The lost revenue is perfectly offset by the lowered expense. It is a natural, functional hedge. It completely neutralizes the Fed's impact on their bottom line earnings per share.
It is brilliant balance sheet immunization. So if the EPS raise isn't coming from interest rate dynamics, we have to ask, where is the growth actually coming from?
Right, what's driving the raise?
The transcript outlines 3 massive organic operational tailwinds. First, Tim Goeke pointed to their sales pipeline.
Okay.
He noted that pipeline generation, so the raw volume of new prospective enterprise clients entering their sales funnel, it rose more than 20% over the first half of the year.
That's a huge jump.
The demand for their tech stack is just accelerating.
And the second tailwind is the backlog. This is actually my favorite metric in enterprise SaaS. They have a staggering $430 million backlog of closed sales sitting on the books from last year.
It's a massive number.
That is almost $500 million of guaranteed contracts that they signed in previous quarters. But the banks are only just now finishing the complex software integrations.
Right. It takes time to install this stuff.
Exactly. Those systems are finally going live, and that massive backlog is converting into actual recognizable revenue right now.
The revenue is already locked in. It is simply a matter of turning on the spigot.
Yes.
And the third tailwind driving the EPS upgrade is their internal data modeling regarding the retail investor. Their analytics project a low teens growth rate in total equity positions for the second half of the year.
Wow, they see it continuing.
They are mathematically projecting that the retail trading volume will remain incredibly hot and that increased volume flows directly into their processing fees.
And while all of this operational execution is just firing on all cylinders, we have to look at what they're doing with the actual cash they generate.
This is the best part.
The transcript notes they remain on track for over 100% free cash flow conversion.
This is perhaps the most vital health metric for a mature dividend-paying company. Let's explain the mechanics of free cash flow conversion over 100%.
Please do.
In corporate accounting, net income is often an illusion. It is a paper number manipulated by depreciation, amortization, and non-cash charges. You can report a massive net income on your income statement, but actually have very little cash in the bank.
Right, because if you spend $1 billion building a data center, the cash leaves your bank account immediately. But accounting rules force you to slowly deduct that expense from your net income over like 20 years.
Exactly.
So your net income looks high, but your bank account is empty.
Precisely. But Broadridge is reporting a conversion rate over 100%. That means for every single dollar of net income they report on paper, they are actually generating more than $1 of pure, unrestricted cash that flows directly into their treasury.
That's incredible.
It proves that their earnings are exceptionally high quality and cash generative. In just the first 6 months of this fiscal year, they generated $319 million in pure free cash flow.
Wow.
That is an explosive jump from the $56 million they generated in the exact same period last year.
That is an absolute tsunami of cash, and they are deploying it incredibly aggressively. They aren't hoarding it. The transcript details that they spent $126 million on 3 specific acquisitions.
Yeah.
And they used a very specific Wall Street term for these, tuck-in acquisitions.
A tuck-in is a highly strategic M&A maneuver. Instead of trying to buy a massive, completely different business and risking a messy corporate integration, a company buys a smaller, niche technology provider that perfectly slots into their existing product ecosystem.
So it just tucks in.
Exactly. It tucks right into an existing sales channel.
And the biggest of these tuck-ins was a company called Accolyn, which they acquired in early January for $70 million. Tim Goeke was very specific about the strategic value here.
Yeah, he was.
Accolyn fundamentally expands the suite of services Broadridge can offer to mutual funds in the European market.
And the European fund market is notoriously fragmented and complex due to varying national regulations. Goeke noted that Accolyn allows Broadridge to service the entire life cycle of a European fund.
The whole thing.
From the initial legal creation and regulatory registration of the fund, all the way through to the ongoing distribution and shareholder reporting across different European borders.
It is the classic build versus buy decision. Instead of spending 5 years trying to organically build out compliance software tailored to French and German fund regulations, they just deployed $70 million of their massive cash flow to buy the leading platform.
And instantly cross-sell it to their existing global banking clients.
Right. They also successfully integrated acquisitions of a segment from FIS and a company called Signal.
But here is the ultimate flex of this entire transcript.
Let's hear it.
Yeah. They spend all this money on acquisitions. They are heavily funding the Canton Tokenization Network. They're building massive AI models for JPMorgan. And yet, their free cash flow is so robust that they still had enough capital left over to return $367 million directly back to their shareholders.
In just 6 months.
In just the first 6 months of the year.
$367 million returned. That is a combination of their growing dividend yield and highly aggressive stock buybacks.
Yep.
They're actively shrinking the total number of shares outstanding on the open market, which mathematically makes every remaining share more valuable.
It's beautiful to watch.
It is truly a masterclass in corporate capital allocation. They are having their cake and eating it too. They are expanding globally, dominating the tech frontier, increasing the dividend, and buying back their own stock simultaneously.
Which naturally leads us to the final, most crucial phase of our analysis. We have dissected the headline anomalies, we have unpacked the mechanics of their blockchain and AI deployments, and we have translated the balance sheet engineering behind their raised guidance.
Yep, we've covered the map.
Now, we must synthesize this into a clear, actionable verdict.
Let's do it. On Talk Tickers, you know we do not hide behind generic summaries. We take a definitive, opinionated stance based on the data. And looking at the totality of the Q2 2026 earnings transcript from Broadridge Financial Solutions, our verdict is absolute.
It really is.
This is a strong, bullish signal.
I am in complete agreement with that. The bullish thesis here is anchored in their unparalleled strategic execution.
Absolutely.
Broadridge is running a textbook monopoly defense. They are locking in incredibly sticky, high-margin, predictable revenue from their legacy governance and trade processing businesses.
The ultimate toll booth.
Exactly. They are the toll booth on the traditional financial highway, and that toll booth is incredibly lucrative. But they suffer from zero corporate complacency.
None at all.
They are taking the massive cash flows generated by that legacy monopoly and aggressively weaponizing them to build and dominate the infrastructure of the next generation.
The Canton Blockchain Network. The distributed ledger repo settling $9 trillion a month instantly. The AI custom policy engines rewriting how megabanks vote.
All of it.
They are actively building the futuristic teleporter, but they are funding it entirely by collecting tolls on the old highway. And they're doing all of this while simultaneously raising their bottom line earnings guidance and returning hundreds of millions of dollars to shareholders.
So what does this actually mean for you, the retail investor holding this stock or perhaps screening it for a potential position?
Yeah, let's make it actionable.
You must understand the exact nature of the asset you are buying. Broadridge represents a profoundly unique, almost contradictory investment profile. It is the ultimate picks and shovels play for the Web3 and AI revolution.
That picks and shovels analogy is so vital here. During the California gold rush, the people who generated the most consistent generational wealth were not the prospectors gambling their lives panning for gold in the river.
No, they usually went broke.
It was the merchants. The guys selling the pickaxes, the shovels, the tents, and the blue jeans to the thousands of miners.
Precisely. If you want exposure to the tokenization of the global financial system, you don't have to gamble on which specific cryptocurrency is going to win.
Right.
You don't have to guess whether the Ethereum network or the Canton network will become the ultimate global standard for smart contracts. You don't even have to bet on whether tokenized corporate debt will entirely replace traditional bond issuances.
So what do?
You just buy the company that processes the atomic settlements, reconciles the cross-chain taxes, and legally routes the proxy votes for all of them, regardless of which underlying cryptographic protocol emerges victorious.
And the absolute beauty of this specific picks and shovels play is its downside protection. It comes completely wrapped in the safety of a highly profitable, dividend-paying legacy monopoly.
It's incredibly safe.
If the blockchain revolution stalls due to regulatory crackdowns, or if true decentralized tokenization takes 10 years longer than the utopians predict, you are not holding a bankrupt tech startup.
You're holding Broadridge.
Broadridge will simply continue to pay you a growing compounded dividend and aggressively buy back their stock using the billions of dollars in cash they generate from, mailing out physical mutual fund proxies and processing traditional equity trades.
The downside is heavily protected by the boring plumbing,
while the upside is infinitely tied to the sci-fi teleporter.
It is a risk-reward asymmetry that is extraordinarily rare in public infrastructure companies. But before we close out this deep dive, there is a broader philosophical premise buried in this transcript that we really need to address.
Okay, lay it on me.
It is a thought that fundamentally flips the narrative of financial technology on its head.
What is the premise?
Imagine the state of global finance a decade from now. Just picture it. Imagine a fully realized tokenized ecosystem where every single equity trade, every corporate dividend payout, every proxy vote, and every capital gains tax law settles instantly, autonomously, via decentralized smart contracts on a global blockchain.
That's the dream, right?
For the last 15 years, the loudest voices in the crypto space have promised that this exact technological utopia would utterly destroy traditional Wall Street.
Oh yeah, they've been calling for their heads forever.
They claimed decentralization would violently disintermediate the legacy middlemen, bankrupt the old-school clearinghouses, and eradicate the boring plumbers of the financial system.
The great inevitable disintermediation of the middleman.
Exactly. But what the data and the mechanics in this Broadridge transcript reveal is the exact opposite reality.
How so?
The legacy plumbers are not going bankrupt. They are the ones aggressively writing the code for the smart contracts. They are the ones founding the institutional blockchains.
Oh.
If Broadridge successfully executes Tim Goeke's promise to fully integrate self-custody digital wallets with traditional brokerage proxy accounts by the end of this year, it raises a stunning reality.
Which is?
The boring legacy plumbing company is aggressively positioning itself to become the centralized nervous system of the entirely decentralized tokenized stock market.
Will the old school plumber ultimately own the futuristic teleporter? Man, it is an incredibly provocative thought. The tech disruptors built the blockchain, but the legacy monopolies are the only ones who actually understand how to make it legally compliant.
Exactly. It completely changes how you view a supposedly sleepy administrative infrastructure stock.
It really does.
The financial revolution will not be a decentralized anarchist utopia. It will be seamlessly reconciled, tax compliant, and fully integrated into the legacy system, entirely courtesy of the cash flow from Broadridge.
And that, right there, is exactly why we obsessively read the earnings transcripts. Thank you for joining us for this special Talk Tickers breakdown. We have gone deep into the atomic settlements, unpacked the AI logic trees, translated the balance sheet hedges, and hopefully given you a completely new perspective on the hidden mechanics of the market.
It's been a fun one.
Because sometimes the most explosive, world-changing technology isn't hiding in an unprofitable Silicon Valley startup burning venture capital. Sometimes it is hiding in the remarkably lucrative, mathematically pristine operations of the exact company that legally mails you your annual proxy votes. Keep questioning the numbers behind the narratives, keep hunting for the mechanics driving the headlines, and we will see you on the next deep dive.